Welcome to The Explainer. Today, we're going to decode the visual language of the stock market. Seriously, we're going to learn how to read the stories that these price charts are trying to tell us, all through something called chart patterns. So let's get right into it. You know, when you first look at a stock chart, it can honestly feel like you're just staring at a bunch of random, unpredictable squiggles, right? A chaotic mess of ups and downs. But is that really the whole story? Is it all just noise? Well, the thing is, not always, because you have to remember, what drives the market is human psychology. It's all fear and greed. And those huge collective emotions, they actually end up creating recognizable shapes on the charts. These are the visual clues, the patterns that can start to bring a little bit of order to all that chaos. But before we can read the sentences, which are the patterns, we have to learn the letters. And in the world of charting, those letters are called candlesticks. So let's start with the absolute fundamentals. Okay, so each one of these little bars you see is a candlestick. Just think of it like a quick snapshot of a battle between buyers and sellers over a certain amount of time. The thick part, that's called the body. It shows you where the price opened and where it closed. And those little thin lines sticking out, we call those wicks, and they show the highest and lowest prices that were hit during that time period. The colors make it super easy to understand at a glance. If it's green, that means strength. The price closed higher than it opened, which tells you the buyers were in control. If it's red, that means weakness. The price closed lower than it opened, so the sellers won that round. It's a really quick visual summary of the market's mood. All right, now that we know our alphabet, let's start making some words. We're going to kick things off with a major category called reversal patterns. And just like the name says, these are shapes that signal a current trend might be running out of gas and is about to turn around. First up, we've got a classic, the double top. It literally looks like a capital M, but it's more than just a shape. It's telling a story. See, the price goes up and hits a high, making a peak. Then it pulls back a bit. The buyers try to push the price to a new high again, but they fail. They get stopped right at that same previous peak. That second failure is the big clue. It tells you the buyers are getting tired, and the sellers are probably about to take over. And here's what it looks like with actual candlesticks. You can see that first peak, the little pullback, and then that second peak where the buying momentum just fizzles out. And look what happens right after that second top. The price starts to drop as everyone's confidence in that uptrend just kind of evaporates. Now, for pretty much every pattern, there's an opposite. Meet the double bottom. If the double top was an M, well, this one's a W. Here, the sellers are in control, pushing the price down to a low. But then buyers step in, and it bounces. The sellers try again to push it lower, but they can't break past that previous low point. That refusal to go lower is a really powerful sign that sellers are losing steam, and buyers are starting to see a bargain. Let's look at the candlestick version. You can clearly see those two distinct bottoms creating a strong floor, a support level that the price just doesn't want to break through. After that second bottom holds strong, you can see the buyers start to step in with more confidence, and that could be the start of a whole new uptrend. This next one is probably one of the most famous patterns out there, the head and shoulders. It tells the story of a dying uptrend in 3 parts. Part 1, a rally to a peak, that's the left shoulder. Part 2, an even stronger rally to a higher peak, that's the head. Then, part 3, a final, weaker attempt to rally that doesn't even make it as high as the head, that's the right shoulder. That failure, that's the key. It shows the uptrend is in serious trouble. And here it is on a real chart. After a good run-up, the price makes these 3 peaks. The big warning sign is that it just can't make a new high after creating the head. Once the price breaks below what we call the neckline, that's the support level connecting the low points, it often signals a pretty significant move down is coming. Okay, so what happens if we just flip that whole pattern upside down? Well, then we get the inverse head and shoulders. This is the bullish version, and you'll often see it at the end of a downtrend. You get a low, then a lower low, and then a higher low. A left shoulder, a head, and a right shoulder all flipped over. It's telling a story of selling pressure finally drying up. So here it is on a chart. After a long sell-off, this pattern starts to show that the sellers are really losing their grip. That right shoulder, making a higher low than the head, is the first real sign of strength from the buyers. If it breaks above the neckline, that can be the signal that a new uptrend is starting and buyers are taking charge. All right, so we've looked at trends reversing, but what happens when a trend just needs to catch its breath? That's where continuation patterns come into play. These are shapes that suggest the market is just taking a quick break before it keeps going in the same direction it was already headed. So let's look at the bearish rectangle. The market's in a clear downtrend, but then it just stalls out and starts trading sideways, bouncing between a ceiling or resistance and a floor or support. This isn't a reversal. It's more like a consolidation. It's a standoff where sellers are kind of reloading for the next push down. And on the chart, you can see the price just gets trapped inside this box for a little while. It's like a pressure cooker building up steam. And once the price finally breaks below the bottom of that rectangle, the original downtrend often kicks back in with a lot of force. And you guessed it, there's a bullish rectangle too. Same idea, just a different direction. The market's in a strong uptrend, but then it pauses, trading inside that little support and resistance box. This isn't really a sign of weakness. It's often just the market taking a healthy breather before the next leg up. The chart shows this perfectly. You've got a powerful move up, then a period of sideways chop inside that rectangle, and then a really decisive breakout above the top of the box. That breakout is the signal that the pause is over and the uptrend is back on. Okay, so we've looked at some pretty powerful patterns, and it can be really exciting when you first learn this stuff and you start seeing M's and W's all over the place. But before we wrap this up, we have to hit pause for a super important reality check. This right here is the most crucial point of all. As our source material puts it, and I think this is perfect, chart patterns are not a guarantee. They are merely an indication of what might happen. You absolutely have to burn that into your brain. And why does this matter so much? It's simple. No pattern works 100% of the time. Period. This is a game of probabilities, not certainties. The best way to think about these patterns is that they help put the odds a little more in your favor. They're a fantastic tool, but they're just one tool in a much, much bigger toolbox. So we've decoded some of the basic language of the charts, right? From the individual letters, the candlesticks, to some of the most common words, the patterns. So the final question I'll leave you with is this. Now that you know the basics of this visual language, what stories are you going to start to see?